Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. Last week I said, I suppose in hindsight somewhat optimistically, that it had been the second week of movement. By that I meant it was the second week of the market moving up and away from the congestion zone previously highlighted, made up of the lesser Fibonacci lines at 1400, 1389 and 1378. These three had halted any falls in this market since late July, and actually held up the market in August and September, the start of October, and most recently the end of October. It seems to me that this action had seen the market gather ammunition for a move higher. Additionally, the large process in operation was a descending triangle, which I had highlighted in blue on my daily chart. The upper trend line used what was the August to date downtrend, currently at 1404, backed up a little higher by the paralleling and declining medium moving average, currently at 1429, whilst below, those same levels of 1400, 1389, 1378 acted as the base of the triangle. Well, all this was well and good. But come this week and we have gone really nowhere. For the most part, prices have held above the medium moving average on a 2 consecutive closing basis and around the 50% Fibonacci line of December 2020 to February 2022 move at 1451, potentially forming a small double top. However, before we start contemplating this possibility and its implications, I think it's best to reprise the potentials on the upside first from the descending triangle pattern. Thus, as I said last week, and I quote, "I'm still mindful this could be a false break, so we'll just take care." So taking all that into account, a primary target X will be in the 1545 area, and a secondary and much harder to reach target X1 will be in the 1605 area. I added last week, and I quote, which has turned out to be very present, and I quote again, well, I quote from now on. So what have we topside that might get in the way? Well, to be honest, not much. Which is why I'm a little surprised and concerned that prices have not moved higher than they have. You see, we have highs in September at 1493 and 1508, but the next clear resistance topside is a band between 1521 to 1534, containing the flatlining long moving average, currently at 1532, and the 50% Fibonacci line for 2022 at 1532. Interesting, they're both at the same level now. So for the second week, it all very much depends on whether the current break higher is a true break or a false one. End of quote. We are now into the third week, and I am still surprised and concerned about it being a false break. Chicago soybean meal. We have had here, and have here still, for a number of weeks now, different patterns, not so much melding with each other, but rather crashing in and out of each other. The main pattern has been the May to date seemingly broken, but not quite broken, then not quite broken, and then most recently broken lower again, ascending expanding wedge pattern, something I pointed out many weeks ago. This has developed currently at 409.20 to 495.70, though it's not a perfect pattern by any means. To assist in seeing this pattern, I've highlighted it in blue. The latest on this is another breach on the downside last week, after spending most of that week back up and above and inside the pattern. The very recent action has been capped by the short medium moving average, currently 412.40, and we are, cautiously, sitting below the lower trend line, once again. Interesting, the lower trend line is also the neckline of another pattern. That's the huge December 2021 to June 2022 head and shoulders continuation pattern. That's currently at 409.20. This second earlier pattern had been the signature pattern here since last year, and you can see how it resonates even now. It has the unusual though not unique feature of a head and shoulders top over February to April, crowning the head of this bigger head and shoulders pattern. Now going back to the neckline, this shallow uptrend had also been the base of a quad and arguably a quintuple bottom. So when we had a breaker below that, it all became very interesting. This highlighted the next key obstacle on the downside, which was, and still is I suppose, the 50% Fibonacci line of the October 21 to March 22 move at 400.50, which has, as you can see, halted a decline late last week, and this week as well, seemingly acting as support. My earlier thoughts on this actual support were, let's say, not complementary to any attempt lower, and the action since has highlighted that comment, and I quote, "Well, good luck with that. The market has tried that a total of 6 times so far since May with no result. I just keep an eye on the parameters, the ascending, expanding wedge pattern, as that seems to be the key here." End of quote. We are, as of today, up to a possible 10 individual attempts lower. Not days, but groups of days bundled as attempts, and so far, well, not making it. Over the last few commentaries, I had a suspicion that the moves lower might still, in the end, be successful. I'm not yet convinced that this idea is incorrect. So, with that in mind, below the 50% Fibonacci line at 40050, we have another 50% Fibonacci line at 386.80. This seems a reasonable area to look at next on the way lower. I had previously placed some ideas on the downside, thus for an ascending expanding wedge pattern, a primary target X would be in the 367 zone, and a secondary harder to achieve target X1 would be in the 342 zone. These are big numbers to think about, and they are based on the move lower still being a genuine one and not a false break, which, given what we have seen in October and now in November, is still open to interpretation. Chicago soybean oil. A lot of lines here because a lot is going on. The key recent features here have been the weekly key reversal up made 4 weeks ago. Also, and this is the most relevant one this week, the bow tie formation made 2 weeks ago between the rising short moving average, currently 72.26, the gently rising short medium moving average, currently 67.84, and a flatlining medium moving average, currently 65.98. This is not a perfect bow tie formation, as the medium moving average was declining when it crossed, but it is worth considering in light of that weekly key reversal up and the subsequently higher action, especially the market moving and stabilizing, well, for a while at least, over the rising long moving average, currently at 70.28. So back to the bow tie. In a bow tie formation, not only does the market have a tendency to move in the same direction that the moving average has exited the bow tie, in this case mainly higher, but after 15 to 20 sessions after the crossover, that is between the 15th and the 22nd of November, we should see the start of a major move in the next direction of the market. Again, mainly higher as indicated by the majority of moving averages moving upwards. So I hope that is all clear. Other than those points, we have also seen the market during October move above the broken lower tie, currently at 71.71, highlighted in blue of the December 21 to June 2022 bullish Andrews Pitchfork, and the 50% Fibonacci line for 2022 at 71.97, as well as the 2008 previous all-time high at 72.67. We're also seeing the market last week challenge the middle tiny of the October 2021 to June 2022 bullish shift pitchfork, currently at 75.97, which I've highlighted in red and is incredibly important. This middle tine has been crucial, as it not only halted the rise, but yesterday and again today has forced the market lower, back down through all that resistance that had turned into support, such that prices are now back to testing the combination of the June 2021 high at 70.33 and the flatlining long moving average, currently 70.28. What is more interesting is that this move, though not necessarily in the main direction of the bow tie formation, was right on schedule. I said earlier, in between the 15th to the 22nd of November. The seeming next major move lower started on the 16th. However, I'm ever cautious, so watch and see what happens by the 22nd. Now, one final point I'd like to discuss. It's an old point, but I want to discuss it still, which I highlighted these past 3 weeks and also mentioned in my earlier commentaries. Here's my reasoning from 3 weeks ago, and I quote, "I have had a suspicion that the action since June may be culminating in an extended V-bottom pattern. An extended V-bottom pattern is much like a regular V-bottom, but the upward moving leg of the V has an extension such as a bull flag or some other form of congestion, much as we have seen here. Extensions may happen before the V as well, but for this particular market, we'll look at it happening post-V bottom. Thus, it would not be surprising to see for this pattern, should it continue to see a move to the 74 even area. Given all that has already happened, these actions negate the monthly key reversal down we saw in September, and if they don't, then a move up to the 74 even area most certainly would." End of quote. As you can see, we're advanced from 69, 65 area up to over the 74 area. So the extended V-bottom pattern with what looks like a bullish halfway hesitation has been a good one. I reckon I'll no longer cover this point, as I've already pretty much flogged it to death. Flogged by me. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes a final bit.